Today, we're diving into one of the most mind-numbing displays of analyst incompetence we've seen in a while. Five highly paid analysts, all with their fancy degrees, glossy titles, and platforms to influence millions of investors, managed to completely bungle their calls on Rivian Automotive, RIVN. How does that even happen? How do you miss something so blatantly obvious? The signs were there, the numbers were clear, and yet somehow, these so-called experts tripped over their own spreadsheets. It's almost impressive how wrong they were. What happened to Rivian was no accident. The twists and turns in this company's story were out in the open for anyone willing to look deeper, but they didn't. These analysts bought into the hype, maybe got a little too cozy with Rivian's narrative, and now everyday investors are paying the price. The way they misread the company's fundamentals borders on outright negligence. And that's where today's lesson begins. It's not just about tearing apart these failed forecasts, although believe me, we'll do plenty of that. It's about showing you how to avoid being led astray by the so-called experts. Because at the end of the day, no one is going to care about your portfolio more than you. If Rivian has taught us anything, it's that you need to dig deeper than the headlines, and certainly deeper than these analysts ever did. And speaking of digging deeper, if you're serious about taking control of your investments and leveraging the power of real insight, you need to start thinking about how AI is transforming the game. AI isn't just for companies like Rivian, it's for creators like you. Right now, the few who understand how to properly harness AI are going to be light years ahead of those who don't. If you've ever thought about launching your own YouTube channel or want to skyrocket the one you have, Matt Parr's Tube Magic course is the cutting-edge solution that you need. It shows you exactly how to use AI to grow a successful channel. Imagine AI working in the background, handling the grind, while you focus on what really matters, producing killer content. Click the link in the description to learn more. Don't get left behind. The few who choose to take this plunge will be the envy of the many who don't. Rivian Automotive was far from immune to challenges, grappling with issues that were impossible to overlook. Yet somehow these analysts we will expose today managed to do just that. Missed cash burn projections, overly optimistic revenue targets, and a complete disregard for production delays. But these experts, blind as bats. Stay tuned, because later on in this video, we're going to break it all down, so you can avoid getting caught up in the same mess. Welcome to the Incompetence Court, where our first defendant, Vijay Rakesh from Mizuho, blew away the incompetence meter. Rakesh managed to miss the mark on nearly every major indicator, despite all the clues being right there in front of him. How does a professional analyst get it this wrong? Let's get into it. Vijay began covering this stock right after the IPO in December of 2021. Vijay wasn't shy to grab his pom-poms and play a solid game of chase and cheer with a series of 145 overbid price-targeted buy calls. He continued to play this game all the way into the trenches, where he segued into a few neutral calls that essentially matched the actual price of the stock. In all this, Vijay maintained a strong buy rating for Rivian Automotive, despite clear financial challenges. His optimistic stance was driven by Rivian's potential to become a leader in the electric vehicle market, bolstered by its partnership with Amazon and ambitious production goals. His enthusiasm was rooted in the long-term prospects of the EV sector, Rivian's innovative technology, and its ability to scale up production. However, he overlooked critical warning signs, such as the company's substantial cash burn and staggering quarterly losses, $1.71 billion in one quarter, compared to relatively modest revenue figures. Rivian's ongoing struggles with production and supply chain issues also flew under the radar, making his high price target seem increasingly out of touch. So Vijay ignored the writing on the wall, told you to buy at the peak, and as it crashed, and then turned around in the trenches and claimed that he doesn't know what is going on, after everyone who listened to him likely went bankrupt. Guilty as charged of gross incompetence and sentenced to 15 years of manual number crushing at your nearest investment bank. Our next culprit today, Emanuel Rosner of Deutsche Bank, is being charged with gross incompetence and copying Vijay's homework -20. Look at that chart. Definitely Vijay's target's -20, more or less. Emanuel began his coverage at literally the same time as Vijay, and I guess they are both on the same cheering squad as he played the same game of nosedive chase and cheer with slightly lower overpriced price targets. Then, similarly to Vijay, he segued into a few neutral calls that matched the stock price at the very end in the trenches. Emanuel held a positive view on Rivian throughout the crash, focusing on its premium brand, strong consumer connection, and advanced engineering expertise. He emphasized its potential as a long-term player in the EV market, especially with its expanding consumer base and technology. However, he overlooked significant concerns, such as the slow progress toward profitability and heavy cash burn. While he acknowledged execution risks, his bullish stance downplayed the deeper financial struggles and valuation concerns, making his call look overly optimistic in hindsight. Sound familiar? Guilty as charged on both counts. Jonas of Morgan Stanley yet again followed a similar pattern of incompetence, covering the stock post-IPO only to play chase and cheer into the trenches with overpriced price targets that reverted to the price of the stock, well into the trenches when all of his followers were already declared bankrupt. Absolutely egregious. And to add insult to injury, he didn't even call neutral until his most recent calls in September of 2024. So from this stock's crash, from its high of over $129 to its current price of around $11, this guy essentially touted it as a buy for over a year and a half, as it has lingered between $8 and $28, struggling to go anywhere near where Adam originally touted it as a buy. And to be clear, I'm not just singling Adam out. Almost everyone on Wall Street was guilty of this. And to add insult to injury, the analysts never even called sell. They simply called neutral. This is indicative of something else that we have been exposing on this channel. Essentially, when analysts say neutral, it is akin to them saying, "Get the hell out." They are afraid to call sell because they don't want to ruffle the feathers of their investment bank's biggest clients. And no, that isn't you. The investment bank's biggest clients are the companies that they do investment banking deals with, and thus also the very companies that these analysts are supposed to be scrutinizing. So essentially, these analysts often end up acting as unofficial relationship managers between their firms and the companies that they report on. Conflict of interest? You betcha. And newsflash, Wall Street doesn't give a damn about you. All they care about are those big deals, and they print false recommendations to prop up companies even when they know that the paper they are peddling is worthless. It is all a scam. Stay tuned until the end, and we will show you how you can use this to make more informed decisions. Our next defendant, Jordan Levy of Truist, followed a similar pattern of incompetence, albeit with a different time schedule. Jordan began covering this stock about a year and a half after the IPO, almost in the trenches, and still had the audacity to play chase and cheer. Jordan began in the first quadrant of the trench with a series of overpriced buy calls and continued to cheer and chase the stock price by lowering his estimates as it continued its descent into financial hellfire. Then he matched the stock price and continued to cheer buy until February of 2024, where he finally decided to throw in the towel and segue into neutral. Rivian management must love these analysts. Guilty as charged with gross incompetence. Our final defendant for the day, Daniel Ives of Wedbush, is being charged with incompetence on another level. Daniel began covering this stock right after the IPO, grabbed his pom-poms, and played chase and cheer in ad nauseum. Daniel has been optimistic about Rivian's stock, driven by strategic partnerships and growth potential in the electric vehicle market. He has particularly cited deals like the one with Volkswagen as game-changing, due to their potential to accelerate Rivian's technological and production capabilities. This partnership, for example, focuses on developing next-generation software-defined vehicles, positioning Rivian at the forefront of EV innovation. Ives recently set a price target of $20, indicating a belief that the stock was undervalued relative to its potential long-term performance. However, in his optimism, Ives may have overlooked some key fundamentals. Rivian has faced significant challenges such as production delays, high cash burn, and profitability concerns. The company has struggled with scaling its production to meet targets and continues to post losses, which has raised concerns about its long-term financial sustainability. These operational hurdles are critical in assessing Rivian's ability to compete with more established EV players like Tesla. Any sane person will be skeptical of such calls, especially seeing that Daniel was cheering the stock as a buy at the peak as well. And we all see how that turned out. Could this be a classical case of sunken costs and escalation of commitment? Leave your thoughts in the comments. Guilty as charged, no trial needed. The chart has spoken. As we've explored the optimistic takes from analysts like Daniel Ives, it's clear that their bullish sentiments on Rivian raise questions about deeper biases and potential misjudgments. This brings us to a larger pattern of inconsistency in financial analysis, especially when analysts cheer on stocks at their peak, only to reverse course when the downturns hit. To understand this cycle better, it's crucial to look beyond the surface of these calls and delve into the company's background. Rivian's history, from its founding to its struggles with production and scaling, sheds light on the core challenges it faces, helping us assess its future without relying solely on rosy analyst predictions. Rivian Automotive was founded in 2009 by R.J. Scaringe, with the goal of creating electric adventure vehicles. Rivian sought to differentiate itself in the EV market with its all-electric trucks and SUVs, aimed at eco-conscious off-road enthusiasts. By 2018, the company unveiled its R1T pickup and R1S SUV, drawing significant attention from investors and industry giants alike. This attention culminated in partnerships with Amazon and Ford, and billions in funding to scale production. Amazon ordered 100,000 delivery vans, providing Rivian with a significant commercial backbone to complement its consumer vehicles. The excitement around these strategic partnerships helped fuel Rivian's high valuation and contributed to a successful IPO in late 2021. However, despite its promising start, disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Rivian quickly ran into serious challenges. Supply chain disruptions, exacerbated by the pandemic, slowed down production, making it difficult for the company to meet its ambitious targets. Delays in manufacturing the R1T and R1S impacted deliveries and dampened consumer enthusiasm. On top of that, Rivian's cash burn rate became a growing concern. The company was spending billions to ramp up production without delivering corresponding revenue, leading to ongoing quarterly losses. Rivian reported staggering net losses, which raised doubts about its ability to sustain operations long-term without continued capital infusion. The financial issues became more apparent as the stock began to tank post-IPO. Despite an initial valuation that placed Rivian in the same league as Ford and General Motors, the company's fundamentals told a different story. Rivian's failure to achieve profitability, missed production targets, and burning through cash reserves led to growing skepticism from investors. Additionally, rising competition in the EV space from Tesla, Ford's F-150 Lightning, and new entrants further complicated Rivian's prospects. The stock, which peaked shortly after the IPO, lost more than 80% of its value by late 2022. This sharp decline was a result of the company's operational struggles and mounting financial concerns, which painted a bleaker picture than what analysts, like the ones that were in the hot seat today, had originally forecasted. Understanding production costs versus output is crucial in evaluating a company like Rivian. Financial metrics such as the cost per vehicle produced, gross margins, and delivery rates are vital indicators. For instance, if Rivian's production costs far exceed the revenue generated from vehicle sales, it highlights inefficiencies that could jeopardize long-term profitability. Monitoring these figures can provide investors with a clearer picture of whether a company is genuinely scaling its operations effectively or merely riding the hype wave. Hype plays a significant role in the electric vehicle market, largely fueled by Tesla's dominance. However, it's essential to recognize that Rivian isn't led by a visionary like Elon Musk. While Rivian's management may very well be competent, the overwhelming hype surrounding the brand has created inflated expectations. As Rivian is given valuations comparable to established automakers like Ford, it's vital to scrutinize their actual performance. When evaluating such companies, focusing on real metrics rather than buzz is crucial, as investing based on hype can lead to significant financial trouble down the line. Another important lesson is that when analysts issue a neutral rating, it can often signal a subtle yet significant warning to investors. It may be time to sell. These ratings can act as a form of unofficial relationship management, where analysts maintain connections with companies while withholding their candid assessments. This creates a scenario where, if an investor holds a stock that suddenly begins to decline, a wave of neutral ratings from previously positive analysts can feel like a collective retreat. By the time these signals are clear, it may be too late for shareholders to react effectively. Therefore, investors must approach analyst ratings with caution and conduct their own due diligence. For if you fail to do this, you just may wake up one day, turn on YouTube, and see yourself sitting in the incompetence court. So, keep analyzing, keep investing, and keep learning, because the path to financial literacy is paved with informed choices and critical thinking. Feel free to check out this video for a high-level discussion of technical versus fundamental analysis and how we use these in our decision-making flow.